Remember Paul Volcker? In part 9, we saw him raise interest rates to 20% to break inflation. The cost was brutal: a devastating recession, millions of jobs destroyed, a debt crisis across all of Latin America. But think for a moment about what that means. A single man, with a single tool, changed the direction of the world's largest economy. He was not a politician. Nobody elected him by popular vote. He did not pass any law. He simply moved a lever, the price of money. That lever is called monetary policy. And it is the most powerful and least visible tool that governments have. Today we are going to understand exactly how it works. Welcome to part 13. We have come a long way. We know what money is, how banks work, what markets are, how we arrived at the current system, what the different schools of thought have to say. Now it is time to talk about something that affects all of those elements: the state. What governments do with the economy. What tools they have. When they work. When they do not. We start with the most powerful and least visible tool: monetary policy. What central banks do with the price of money. Imagine the economy is a house with heating. Interest rates are the thermostat. If the house gets too hot, meaning there is too much economic activity and prices start rising, the central bank raises rates. That makes borrowing more expensive. Businesses take out fewer loans. Consumers spend less. The economy cools down. If the house gets cold, if there is recession and unemployment, the central bank lowers rates. Borrowing gets cheaper. Businesses invest. Consumers buy. The economy picks up again. It is an elegant mechanism. And for decades it was the primary tool of central banks. The Federal Reserve in the United States, the European Central Bank in Europe, the Bank of Japan. Volcker applied this logic in its most extreme version. We already know the story: rates at 20%, brutal recession, inflation tamed. What matters here is not repeating the facts, but understanding the mechanism. Why did it work? Because raising interest rates is not just making borrowing more expensive. It is sending a signal. It is telling the entire economy, we take inflation seriously. If businesses and workers believe inflation will fall, they adjust their behavior. Unions demand smaller wage increases. Companies raise prices less. The expectation becomes reality. Economists call this the anchoring of expectations. And it is perhaps the most important concept in modern monetary policy. It is not just about moving a mechanical lever. It is about managing the collective psychology of an entire economy. The Volcker case illustrates both the power and the price of monetary policy. It works. But it is not free. There is a problem with the thermostat. It cannot go below zero. Or at least that was the belief for a long time. Japan was the first country to discover this. After the bursting of its real estate and stock market bubble in the early 90s, the Bank of Japan kept lowering rates year after year. In 1999 it reached zero. The economy remained stagnant. Prices were not rising. In fact, they were falling. Japan entered deflation. The economist Paul Krugman called it the liquidity trap. When rates are at zero, the opportunity cost of holding idle cash is zero. No matter how much money you inject into the system, people and businesses hoard it instead of spending or investing it. It is like pushing on a string. No matter how much force you apply, the string does not move. Japan had gone decades without growing significantly. Its population was aging. Its companies were hoarding cash. And the central bank, with rates at zero, seemed to have run out of ammunition. What Japan discovered in the 90s became the problem of half the world after the 2008 crisis. The United States, Europe, the United Kingdom. All hit the lower bound on rates. And all had to invent something new. That something new was called quantitative easing, or QE. The name is deliberately technical. If they had called it what it was, creating money out of thin air to buy debt, it would have generated more alarm. The mechanism works like this. When a central bank does QE, it creates electronic bank reserves, money that did not exist before, and uses them to buy government bonds and other financial assets on the open market. By buying those bonds, it pushes their price up. And since a bond's price and its yield move in opposite directions, the yield drops. That makes long-term borrowing cheaper, even when short-term rates are already at zero. The Federal Reserve started its first QE program in November of 2008. Between 2008 and 2014, it purchased more than $3 trillion in treasury bonds and mortgage-backed securities. Its balance sheet went from under $1 trillion to over $4 trillion. The European Central Bank took longer to act. Mario Draghi launched the purchase program in 2015, after his famous 2012 speech in which he promised to do whatever it takes to save the euro. And then the pandemic hit. In March of 2020, the Fed announced purchases of $700 billion. The ECB launched an emergency program of €750 billion. Within weeks, the world's central banks injected more money than in the entire previous decade. The effects of QE remain debated. Defenders say it prevented a financial collapse in 2008 and a depression in 2020. Critics point out that it inflated the prices of financial assets, disproportionately benefiting those who already own stocks and real estate, and contributed to the inflationary wave of 2021 and 2022. Both have a point. And that is the nature of monetary policy: there are no interventions without side effects. When QE was not enough, some central banks went further. The European Central Bank introduced negative rates in 2014. The Bank of Japan did so in 2016. Switzerland, Denmark, and Sweden also adopted them. The idea is counterintuitive. A negative rate means banks have to pay to deposit money at the central bank. It is an incentive for them to lend instead of hoarding reserves. In practice, it is like charging a fee for storing money. The results were modest. Negative rates did not cause the catastrophe some feared, but they did not spectacularly revive the economy either. In Japan and Europe, growth remained slow. Another tool invented in this era was forward guidance. It consists of the central bank publicly announcing what it plans to do in the future. If the Fed says it will keep rates low for the next 2 years, markets react immediately, making long-term borrowing cheaper without the need to move rates today. It is monetary policy made with words instead of money. And it works, as long as markets believe what the central bank says. If credibility is lost, words stop having an effect. Everything we have seen points to an uncomfortable conclusion. Monetary policy is powerful, but it has clear limits. First limit: it can curb inflation with relative effectiveness, but stimulating a stagnant economy is much harder. It is easier to cool an economy than to heat it up. Raising rates always works, because making borrowing more expensive always reduces demand. But lowering rates does not always work, because making borrowing cheaper does not force anyone to borrow. Second limit: the effects are uneven. When the central bank lowers rates or does QE, the first to benefit are financial markets. Owners of stocks and bonds see their wealth rise. Those without financial assets notice little or nothing. Monetary policy can widen inequality even when trying to help the economy. Third limit: the liquidity trap is real. When rates hit zero and the economy still does not respond, the central bank is left with very little room. Unconventional tools, QE, negative rates, forward guidance, help, but they are not perfect substitutes for traditional interest rate policy. And fourth limit: monetary policy cannot solve structural problems. If an economy is not growing because its population is aging, productivity is stagnating, or infrastructure is deteriorating, no interest rate is going to fix that. For an ordinary family, monetary policy seems like something abstract. Decisions made by distant people in imposing buildings. But few economic instruments affect daily life as much. When the central bank raises rates, the mortgage gets more expensive. Monthly payments go up. Some families can no longer afford the house they bought. Small businesses that depend on credit see their costs spike. When the central bank lowers rates, savings stop earning returns. Retirees living off their savings see the yield on their deposits approach zero. And young people who want to buy a home discover that low rates have inflated prices beyond their reach. It is the paradox of monetary policy. Every decision helps some and hurts others. And those who suffer the most tend to have the least voice in the decision. 3 ideas to take away from this episode. First, monetary policy works primarily through interest rates. Raising them cools the economy and reduces inflation. Lowering them stimulates it. The Volcker case showed that a determined central bank can break inflation, but at an enormous social cost. Second, when rates hit zero, central banks turn to unconventional tools: quantitative easing, negative rates, forward guidance. These tools work partially, but do not fully replace traditional rate policy. The liquidity trap, which Japan has been experiencing for decades, marks the boundary of what monetary policy can do. Third, monetary policy is not neutral. Its effects are distributed unevenly. It can curb inflation or prevent a financial collapse, but it cannot solve structural problems like demographic aging, low productivity, or inequality. Central banks control the money lever. But governments have a second lever, one that is even more politically explosive: how they collect taxes and how they spend. That is fiscal policy. And it is what we will look at next time.